Panxora have been in the crypto since 2014. I joined the company full-time in 2017 with the goal of setting up the trading and investment part of the business. During that time, we've developed our AI-based approach to trading major cryptos, as well as launching a crypto hedge fund and successfully investing in a number of token startups. This experience has led us to develop a pretty unique approach to investing in startup token projects that overcomes a number of the problems associated with this space. Either the target company needs to give away a large slice of equity, not good for founder motivation, or the early investor takes all the risk with a very uncertain return profile based on the token performance, not good for the investor. When we structure a token investment, we focus on early stage companies looking to do their first token sale. Typically, they will be looking to raise $1.5 to $3 million plus from token investors. To do this effectively, we believe they need a war chest of at least 400,000 to $1 million, depending on the size of their liquidity event. That's where we come in. We provide, along with our syndicate of investors, the early investment needed to support their public launch. We structure the deal with 3 key elements in mind. As usual, we receive tokens at a discount to the public sale price. We would typically expect to receive the full value of the investment in tokens at a 50% discount to the public sale price. But we also structure a revenue share deal with the target company, and I'm going to come back to that a bit later. And then 1/3 of the investment amount is invested in our large cap crypto fund for the benefit of the investors. This gives the investors the opportunity to benefit not just from the token launch, but also from the movement in the major crypto markets on every investment they make. So coming back to the revenue share, when we invest in a token project, we work with them to set up a good governance process for managing their cash flow. Part of that governance process is the management of their treasury operations and the treasury operations for their full token fundraise. More and more large enterprises have recognized the benefits of holding some of their treasury in Bitcoin. We provide the same capabilities to our client companies. We use the same models that power our hedge fund to actively manage the treasury operation. The profits we make from this activity is split 50% to the target company and 50% to the investors. This gives the investors 50% of the profit generated from a pool that's usually 3 to 4 times their original investment capital. So you can see from the multiple revenue streams, this is a good deal for investors. But what about the company? How do they benefit? Well, first they receive that early injection of cash that is essential to successfully launching their project. They also generate additional profit from their treasury operations, with us providing the trading and the risk management expertise. And most importantly, they're not giving away large tranches of their equity at a stage of their growth when it's likely to be expensive to do that. So I'm going to wrap it up because I'm running out of time there, but I want to quickly mention some nuts and bolts about the way we invest. So firstly, all the deals we invest in are syndicated to other like-minded investors that meet our accreditation requirements. They all invest alongside us into the target companies. A typical deal is in the range of $500,000 to $1.5 million. We use an FCA regulated administrator and custodian to help administer the deals and the cash flows, protecting us and our investors. Each deal lasts 30 months from the launch, after which time the SPV that we use is collapsed and the profits distributed to the investors. The tokens that are received are distributed to investors immediately as soon as they are issued. This allows them to manage their token portfolio exactly as they would normally. So I'm going to wrap it up there. Thank you.